Gold hit a new record, over $2,300 an ounce, as investors weigh whether or not the Fed will cut rates. We discussed the miners a few weeks ago, and we're going to take another look today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic, sponsored by OptionPlay. A few weeks ago we looked at a bullish call spread risk reversal on GDX, the gold metal, the precious metal miners. And they've definitely caught a bid since then. They're up about 15% from that March 19th low, and that significantly outperforms gold, which is up a little over 6%, and silver, which is up about 8.5%. So first things first, what's going on here? And what I would say is that, we keep getting these conflicting messages coming from the Fed, both encouraging investors that they are going to cut rates and then insisting that they're not going to do so too early. This is typical Fed speak. They have, for a long time, tried to speak out of both sides of their mouths, or at least seem like they're communicating without really communicating. And when we get positive economic data, of course, nowadays, we've been starting to see equities in particular get a little wobbly on that, because the assumption then is that you're not going to get that rate cut that everybody's been hoping for. The rate cut is important for gold. It goes into the carry cost for the metal. And what I mean by that is that gold is not an income-producing asset, and if you deploy cash to purchase it, you're foregoing the interest. That's one part of it. And the other is, of course, that raising interest rates is anti-inflationary, and of course, if inflation goes down, then presumably gold as an inflation hedge or bet is going to follow suit. So that's kind of what's going on here. I think the important question, though, for us is whether what we have seen represents all of the move that we'd expect, because that's a big move. Looking at nearly 15% since March 19th at this point. So just over, whatever, we're looking at about 2 weeks. Is this the beginning of a larger move, or is that the move? And the reason that's relevant is because if we're talking about call spread risk reversals, and we'll take a look at one right now. And actually, we're going to try to go back in time a little bit. So if we go back to the 19th, I'm just going to quickly see where we were at that point. So GDX was trading on the 19th on or around, let's just call it $29 for simplicity. So if we had, at that time, been looking out, let's say, to regular way May expiration and targeted a move of this scale or scope, we would have purchased maybe the 30 strike calls and probably sold, the 37s or 38s at the time. 37s or 38s. What am I talking about? More like 10, 15%. So probably these 34s, and then sold a downside put. We'll just pick something that is also about 10% out of the money for what it was then. That's going to be, call it the 27s or something like that. So these would have been also sold. So where are we now? And what we can see is that this trade, which could be worth a maximum of $4 as of May expiration, is already worth $2.30. So would a trade like this need to be adjusted or modified, or would one take profits and so on? My thinking is that the rally for the miners relative to the metal is not over. And in fact, I think maybe to illustrate this point, I want to just refresh everybody's memory as to what it was I was thinking at the time. And that was that the miners had, over a longer period of time, so a couple of things that are interesting about what we've observed. The general sense of it is that the miners, when gold makes a move, will move more than the metal because they are levered to the metal. And they have operating leverage, which they can deploy. And I think we discussed this when we talked about it. But over the long term, over the last 10 years or so, this has not actually held up. In fact, what has happened is that the miners have actually underperformed the metal. Now I'm going to use gold, GLD, the ETF, as a reference because probably everybody has access to that. Not everybody trades the futures. And we'll just go back, let's see here, we'll go back maybe, that's 5 years. So what we can see here is going back 5 years, GLD has outperformed GDX quite considerably by about 26%. We go back a little bit further, go back 10 years now, and that outperformance grows to nearly 34%. But in the short term, there is some leverage. So over the short term, GDX is the place you're going to want to be if you're going to make a bullish bet on gold here. And if you have the call spread risk reversal on that we discussed before, I think it does make some sense to make some adjustments here, but not in a manner to take profits, because as far as I'm concerned, I don't think the trade is over yet. Largely because there was just this prolonged period of underperformance, and if gold catches a meaningful bid and stays higher, ultimately the miners are going to be able to capitalize on it. That will take some time. So what would one do? Well, there's a couple things you could do. One of the things you could certainly do if you were in the call spread risk reversal, and you'll have to forgive me because I wanted to try to grab this right before we started this live stream, but unfortunately, between trading and some other things, I couldn't go back and see which one we were in. We have a trade on in Newmont, which actually I think we have a chart of Newmont. Obviously, this is kind of the biggest player in the space, ticker NEM, November Echo Mike. There it is. So you can see that if you look at it in this longer perspective, that names like this, while the bounce off that bottom was pronounced, and actually there's one other thing I would just quickly ask people to take a look at. You'll notice that this is a pretty prolonged downtrend, and unfortunately I can't annotate the screen. What I would do if I could would just be draw a line across the tops of that downtrend line, because what I really would like to see is a convincing breakout above that downtrend. And I think that's what everybody should be focusing on. So with that in mind, what we can do is we can actually take a look at that local low in Newmont and start, if we're going to look at Newmont, you can do the same thing in GDX, but actually this being a new show, we might as well have a new trade for those who weren't in the earlier one. And for those that are looking to adjust GDX, you can do your trade in a fashion similar to what I'm about to describe, or you could pivot presumably to Newmont, doesn't really matter. But I think it's illustrative. So that local low in Newmont was on or about $30. So why don't we just sort of begin with that level? I'm just going to pull it up here and frame up a trade in a similar fashion. So, you know, when you're doing something like a call spread risk reversal, the objective here is usually to minimize the premium outlay to get some near upside participation. And then in the event that whatever it is that you're looking for, which in this case is that breakout from that downtrend, and for the miners to continue to follow gold higher. And I will say this, I mean, breaking out to a new all-time high in the metal and the commodity gives some additional upside room. If we were sort of bumping up against some kind of a double top or something, that would be more problematic. Okay, so what this would mean then is you're going to try to buy, you know, an at or just slightly out of the money call option. Again, I'm just looking out to May here, selling a higher strike call against it, and then you want to sell a lower strike put, bearing in mind that that level from whence we came was, you know, around that $30 level. That was the, you know, that's the basically that local low that we saw at the tail end of February. Now the problem is, if you want to sell that 30 strike put, you're only going to collect a dime for it. That violates one of the rules I typically have, which is that if I'm going to be short options, I generally want to collect at least 1% or thereabouts of the strike that I am selling. And the most eligible strike for that is the 32.5. That yields about 33 cents, so almost exactly 1% of the strike. Now, bear in mind, this is in slightly over a month, so that's not mind-bendingly exceptional, but it is enough to take a look at it, and then probably looking to either sell the 40s or the 42.5s. Now, one of the things you're going to observe, you do this trade and out to May, is that you are going to have a little bit of a premium outlay here. In this case, it's going to cost about $1 to put the trade on. So you're going to be looking, at somewhere on or around, depending, your mileage will vary, of course, depending on when you get this trade on and how things open up tomorrow. But you're looking at about 3% of the underlying. Bear in mind that although you're laying out premium, and whenever you're laying out premium for something that isn't in the money, and this is not in the money, that essentially is going to translate to your standstill rate of return if the underlying doesn't move. So you know that if you're spending premium and nothing has intrinsic value, that means that none of the options that you're trading are in the money. That's essentially how much you're going to give up. But the interesting thing is that because wing options, as a function of their premium, will decay more rapidly than those at the monies will. So I'm not saying on an absolute basis, because obviously this has to have negative theta through expiration, or you wouldn't have this premium outlay. But as a function of their own price, those wing options are going to decay more quickly. So the actual day-to-day theta of this position isn't going to be all that overwhelming. I will say one other thing, though, and that is that when you start to get a move in commodities, when you start to get a move in the metals, it is entirely possible that options premiums go higher. So in most cases, when we look at equities, for example, as equities go higher, the general sense of things is that options premiums, at least as a function of the price of the underlying implied volatility, is going to come down. That's sort of the idea that most people are familiar with, that the VIX and the SPX, for example, are anti-correlated. SPX sort of trundles its way higher and the VIX goes lower. Commodities don't always behave that way. And in fact, very often they behave the opposite way, where equities have what we call negative skew, what some people will refer to as put skew, which means that in implied volatility space, those downside puts are going to trade at a premium to the calls. In commodities, that isn't necessarily the case. The reason that those dynamics exist, there used to be, people often used to say about equities that they take the stairs up and the elevator down, that stocks sort of climb steadily, but when they start to fall, they can fall with alarming speed. And that helped justify why there was more of a premium to the puts. The fact that investors naturally want to hedge, which creates a demand to purchase puts, or that they want to create some yield in addition to holding their stocks, encouraging the sale of upside calls, would also contribute to that skew. But anything where there is discontinuous pricing, and when I say discontinuous, I mean that the price of the underlying asset, does not move steadily from one price to another. Steadily from one price to another is stocks trading 50, it's trading 50, it's trading 50, it's trading 50 and 5 cents, it's trading 50 and 10 cents, and so on. Discontinuous pricing is stocks trading 50, it's trading 50, it's trading $45. It makes a 10% gap. So when you see those gaps, we sometimes refer to those as jumps. That means that the price is not continuous, and if you expect that kind of discontinuity, then whatever direction that might occur in is generally where you're going to see more of a premium on the option side. And in commodities, when we do get shocks to the system, frequently those shocks result in price increases rather than decreases. That's less true for gold. Gold behaves more like an equity will than some other things. What would be something that does not behave at all this way? What commodity might be subject to violent price jumps? And I'm just talking about that discontinuity in pricing. Something like electricity. in markets where you can trade electricity, prices can be discontinuous. They can jump quite violently. I've seen this kind of thing happen in natural gas. So in natural gas particularly, as you get to the tail end of the withdrawal season, so we're producing natural gas, you store it, you store it, you store it until there's no room to store it. That's the tail end of the injection season. And then during the winter months, you have demand for natural gas, and you deplete those reserves. And if you end up in a situation where demand for natural gas exceeds what you have in storage and whatever is being produced and is available every day, you can get very violent and sudden price jumps. And you will see that kind of thing happen at the tail end of the withdrawal season. And that creates a lot of call skew. So in this example, what I'm saying is that if we get a situation where people are anticipating significant inflation, if we get a situation where it does not feel as if the Federal Reserve is really operating in the best interest of the dollar, and we start getting some types of inflation-oriented shocks, then you could see significant call skew begin to emerge in places where people would be betting on inflation, and that would include precious metals. Okay, so I hope you find that helpful. Like I say, I think for as long as gold is here, I'd rather be in the miners now, because it does seem like the catch-up that we had talked about may actually finally be happening. And it also strikes me that the leverage that miners sometimes exhibit appears to be in full effect at the moment. And one final point I would make just about the price of options on these instruments at the moment. Let's just take a look at GDX. I'm going to do that first. So, for those who don't want to try to pick stocks, GDX options right now, implied volatility, so that's just the way options traders think about the price of options. Going out about 3 months is, we'll call it 32.5, and they have been realizing pretty consistently about 32.5 over a rolling 20 trading day period, dating all the way back now to mid-October. So with that in mind, I also don't mind, and we might as well illustrate this too, because I have a tendency to talk and not show. It's a bad habit now. So we'll just take a look at GDX and just say, if you're inclined to make a 3-month upside bullish bet, you can look out to July or, some similar. But, looking at maybe the 34, 35, let's see what we got here. 34 strike calls. Now, bear in mind that the options play score over here is sort of based on some statistical calculations. And so, the probability of profit, largely because the underlying has to get through that strike. If you hold it all the way to expiration by at least a premium you paid, which is going to be 36 and a quarter thereabouts, that might seem like that's a pretty good bump. My thinking about this is something I talked about on the last show, actually, which is that you can buy some options and then look for opportunities to trade against it. And I think if you do work around your position dynamically, then you don't need to use something like a call spread risk reversal, which is a kind of a trade where you're looking to sell those other options to offset that decay and let the thing sort of sit and bake for a little while, as opposed to just going out and buying calls and then looking to opportunistically perhaps delta hedge off a piece of it, which I also think could potentially make more sense, just bearing in mind that that particular trade is one that requires significantly more maintenance. By the way, if anybody has any comments, questions, concerns, please be sure to put them into the live chat. It's possible, depending, we're trying to get to a point where that lead-in, where the live stream is just sort of sitting there before we actually join you live. that shortens up a little bit so that we don't have to clip it for those who want to watch this in the future, which means hopefully we'll get to preserve the live chat. Which brings up a point, which is that somebody had asked a question more than once, actually, in prior live streams, and I wanted to make sure I got a chance to address this question. And also just to serve as a reminder, too, that what I am going to do when possible is, we're going to go through these questions and try to see whether we can address some of these things in future videos if we don't get to it straight away. Okay, so let's see here. Now, this is going to be awfully hard, I know, for you guys to read. That's just going to stay up there, and I've got it written over here. And I'm just going to read it out loud so that you know what it says. The question is, Mike, how can open interest be used to guide option trading? I look at puts to determine around where the stock is going to trade at expiration, especially around 3:45 p.m. on expiration day and tending towards 4 p.m. The highest open interest option closest to where the stock is trading usually expires worthless. Your thoughts? What do you think? I've noticed that open interest has useful information. Okay, so people use open interest a couple different ways. And I've kind of seen this as, it's a trend recently that has caught fire a little bit for people to think about gamma exposure. What is gamma exposure? What is it that they're trying to identify? And how do I think about it? So first things first, I always felt as a market maker that open interest had a huge bearing on where the stock went, and I was probably partially responsible for this. And why is that? Whenever I was long a strike in good size, so, maybe long a strike 1,000 times or more. What did that mean? Well, what it meant was, actually, you know what? Why don't we let's see if I can find an interesting stock that. Well, we were just talking about Newmont. Let's see if there's anything interesting in there that would serve as an example. Okay. Let's take a look at this. We might have to blow the screen up a little bit. And even once we do, I realize it's going to be hard to read. So I'm just going to try to point out what it is I'm looking at. I think do I have a way to blow this up? I think I might, actually. Let's see. What does this button do? So let's just blow this thing up a whole lot and see what happens. So maybe this is a little clearer. Okay. So what we're looking at right now are the weekly options in Newmont Corp that expire at the end of this week, so 2 days from now. And stock close 37.23, so the closest strike to the at the monies are the 37 strike calls. So those traded 3,800, just about 3,790 contracts today. Open interest was 4,517 contracts coming in. And now we'll just take a look at the put side. So actually not a whole ton of open interest on that strike today, 138. That's not surprising, by the way, because the stock rallied through the strike today. And it's been rallying, right? So Newmont has, since these options were listed, these are weeklies, so they've only been around for whatever, a month or so. And GDX is up 15% since the 19th of March. So what do we know about these puts? These puts were not in the money. So the fact that there's not a lot of open interest on these puts shouldn't surprise us one bit, because it's pretty rare for people to go about trading short-dated in-the-money puts. And actually there was a whole bunch of in-the-money trading going on in DJT today, and maybe we'll get a chance to talk a little bit about that. Okay, so if I was a market maker and people had been selling these calls on balance, and I was the lead market maker, maybe I'm long, and as a specialist, and we did trade some of the miners actually, more in oil services, but if you're the specialist in a name, especially in the single list days, specialist was typically 40%. of all the flow. So if that was all selling and I was doing my typical piece, which would be about 40% of the flow, that means that about 40% of that open interest would have been mine, right? So about 1,800 contracts, give or take. What does that mean for me as a market maker as expiration approaches? Well, there's an interesting dynamic because, of course, if I'm long that strike and I'm hedging my delta, you can see right now the delta here, well, maybe you can see it, but it's 58, close to 50. It's not the money option. But as expiration approaches, the gamma, that's the rate of change in that delta. I mean, theoretically, it's infinite. It's not really infinite. It becomes binary is the way to think about it. If I'm long those call options 1,800 times, that means that I have 180,000 shares of stock to sell above the strike or to be short as of Friday's expiration. And if it drifts below that and I am shorted, I've got to cover that and get it back. So that means that the closer I get to expiration, the more I need to hedge by buying below the strike and selling above the strike. And the very act of doing that is going to compress the volatility of the stock if the open interest is big, and that is in the hands of market makers. What we call that is pinning, and it was something we always dreaded, and that is that we would basically pin the stock to the strike that we owned. There's another reason we didn't like stock pins, and that was that if we happened to be long the call and short the put, and then short stock against it, if the stock landed on the strike, we never really, if it landed dead on the strike, we didn't know whether the short side, the short put side, would get assigned or not. So in theory, we have a position that's completely boxed off, but in reality, we don't know because we don't know what the holders of those 37 puts are going to do. So we would actually sit around on Friday expiration and wait to see where the stock traded thereafter. Does it trade below 37? Does it trade down to 36.90, for example? Because if it does, anybody who holds those puts would be very happy to exercise their puts and pick up the stock at 36.90, or maybe they just think 37 is a good sale. So they end up exercising it. We had to kind of handicap that. Now, what this means is that if there is a lot of open interest and it is in the hands of the market makers on the long side, they can compress volatility, and oftentimes they can drive the underlying, especially in thinner names where the volume is not that exceptional, you can drive it towards the strike. And so that is a possibility. The same effect works, I guess, a little bit in reverse, which is that if we are short the strike, the dealers are short the strike, we have more stock to sell as the stock declines, and we have more to buy as it rises, and that can exacerbate volatility. So in the same way that being long the strike acts like a magnet, and market makers can drive the stock to that strike, when they're short that and are therefore hedging the stock, selling it on the way down and buying it on the way up, it can have the opposite effects, like two magnets that are repelling one another. And so that is an impact. Here's the tricky part. So if you knew all of those things, then the open interest can indeed be very helpful. But you actually need to now get a sense of whether the dealers are long or short the strike to figure out what dynamic is actually at play. And this is a much trickier exercise. A couple ways to do it, I suppose. Sometimes big trades leave footprints in the snow. That is to say that if all of that open interest was the result of a handful of trades, you can go back and actually look at time in sales. So I can go and take a look at the 3,790 contracts that traded today and say, okay, well, what happened there? Were those being bought or sold? Well, we can take a look and say, okay, well, was there a really big print? There was a couple here, so these were trading 375. Let's see how many contracts, 100 plus contracts. So we had a bunch trading towards the close. Okay, so we see there was a bunch trading towards the close. Were those buyers or sellers? Because if it was an initiating seller, then the dealers are going to be long the strike. But let's see here. Now, unfortunately, there's a bad data point in here, so I need to scrub this a little bit. That chart doesn't mean anything, so there's bad data there in the beginning, so let's just get rid of that. Just going to skip out to here. Okay, so this looks very noisy, I know. Let me see if I can try to explain a little bit of what it is we're looking at here. This is the implied volatility. This is the price of that option intraday going through the day. And down here on the bottom, these little things, that's the volume, right? So we can see that there was a couple instances where there are big trades. And right now, I'm actually tracking a whole bunch of stuff, right? So I can ditch the price. I'm really more interested in the implied vol. And I'm just going to get rid of the mid. And so now what do I have? So what I'm actually looking at now is this was the bid for the option. This is the ask of the option. And the white represents where it was trading relative to those in vol space. And what we can see is that there may have been a couple of sales in here. Let me bring the volume back. Oh, I see if that was really big and chunky. So in here, those were sales. That was not particularly big. That looks like a sale, so that was pretty chunky. But later in the day, not so clear. It looks like maybe these were buyers. First of all, it was just higher throughout the day. And I can actually confirm that another way. So I can see that this stuff was all trading in and around, that was right close to the close. That was about 350 right before the close. Just double check that. So let's see what was going off. 350, 375 lot trading 63. Okay. So let's see I want to see what time that was exactly. 351.50 is when that traded. Okay. So we're going to take a look at that moment, and we're going to see what the market was. What was the market when that print went off? I said that was 50, I believe. So let's go out to 1552-ish. That should capture it. And of course I used the wrong function. Really helpful. Here's the one I wanted, because I wanted to see what the market was when it printed. Okay, so let's go back. We're going to scroll back in time. 47 bid, 49, and where did those things go off? I'm looking for that print. Was it 51? 49, 59. Did I miss it? It's right in this neighborhood. All right, now we're going to go back. 47, 49. 63. All right, that was a buyer. It clearly had to be a buyer. Because that was a 50-cent option only minutes before the trade went off. So, and it's not not amazingly high delta. So in this particular case, that open interest is not long held in the hands of the dealer. By the way, some of these other codes, may not mean a whole lot. This was printed by Floor Brokers IS's intermarket sweep, which means that somebody used an algorithm to try to lift offers. But yeah, so those were purchased. So in that particular instance, the open interest, you're not going to have that same gravitational impact. And the other thing is you're probably not going to spend too much time trying to sort out and do what I just did. You're doing a little bit of forensic. What actually happened here? And that can be a little bit cumbersome. And look, you might not even have access to that data. But the short version of this is that it can have an impact, but you need to be able to deduce where the dealers stand. I think that's certainly part of it. Where that pain point is for the people who have those options. And you can also probably get a sense of where that's coming from, just logically, if you just sort of watch how open interest has been building over time. If something's really on a tear, and there seems to be a lot of bullish sentiment, the chances that the initiating flow is, say, selling upside calls is actually quite slim. So you can try to make some assumptions, but stuff like that. Okay, so let's go through some other questions here. Okay. Think I can remove the stop side of one cancels other at open each day and reapply after 10:30 a.m. Oops. You know what? Fred, I'm going to come back to that question because I'm not 100% sure I know what you're referring to. Did we discuss OCO orders at any point? I don't think we did. I'm going to get back to that, because I think that's probably going to be, not that it doesn't deserve to be addressed, but I want to make sure that I'm addressing it with the appropriate context. So, how to play financials going into earnings like JP Morgan and Citi. Okay, so this is interesting. JP Morgan, so it used to be way back in the day, Alcoa was kind of the kickoff for earnings season. Now it's JP Morgan, and actually all the big, the money center banks all essentially report on or around the same time. JP Morgan is going to be reporting on the 12th, which is that next Friday, I think it is, right? Yeah, that's next Friday. So a couple things about that. JP Morgan did not end up closing higher today. Let's look at JP Morgan. I mean, it's the bank to think about. The banks don't typically move that much on earnings. This is a table that we're looking at right here, which shows that hard to read. Once again, I apologize for that. Where's that little zoom function I had over here? Do I have that on the screen? Maybe not. This is the important point, though, right where my cursor is pointed, if you can see it. If you can't see it, don't worry. I'm just going to tell you what it means. What it says is that the average absolute price change for JP Morgan, this is looking at 44 reported quarters, so going back the last 11 years, from the day before they announced to the following close, is less than 2%. They don't typically move that much. That isn't to say that they don't periodically have decent moves. We can see that actually when they reported last year, same quarter, by the way, it was the first quarter of 2023 that they reported on the 14th of April last year, the stock moved 7.5%. But, I don't generally expect really big moves out of them. And this isn't just true of JP Morgan, by the way. It's true of Citi and so. In fact, I think we have a position in Citi. We don't have one in JP Morgan. But there's another dynamic going on here, which is that, the stock has just basically been on a one-way street. So let's ignore the price of options for a second and just take a look at what the price action has been. This has been a very steady lower left to upper right kind of a situation, particularly since April. So the question now becomes, when you say how to play financials, I guess my first question would be, in response to that, what is your position now? Because if you are long the stock, I don't think there would be any shame in taking some of those profits. It's up 46% after all since late October, and buying an option to go through earnings. Don't sell covered calls. Not a trade I like going into earnings. As I've pointed out before, earnings are typically when stocks move. So I wouldn't do that. You could certainly consider a stock replacement strategy or something along those lines. Options are not particularly expensive to basically, press a bullish bet going into earnings. So that's my thinking there. Let's see. So earnings season is beginning soon again. What's your favorite way to play earnings with options? On the long side is the answer. And that's not to say that I don't short premium going into options. I do. Actually, you know what? So I will say this. I don't think this applies so much in the financials just because the premiums aren't really there. Maybe I can find something that tends to move a little bit more on earnings and use this as an example. General case, I'd prefer to be long options than short them through earnings. But I'm about to just try to walk you through an exception to this, which I think is important. Let's see if I can find an earnings for something that really tends to bump around a lot. It's not going to be next week because, like I said, the earnings season is just kicking off. Starts with financials, so you're not going to see anything really meaningful in there. Got some other things coming up soon thereafter, but they've all been beaten up for other reasons, like United Health, for example. United Health, Humana, I mean, I'm sure you guys have all seen the news. Those things all got slammed this week. It was Medicare stuff that was really sort of thumping those ones. Oh, here's one. How about, so the home builders can move, and we've got D.R. Horton. I think D.R. Horton and Lennar, both names we own. Let's take a look, though, at how big the implied move is there. We'll see with it. 4.5%. Is that juicy enough to do this trade? It's a little thin. This one definitely moves a lot more. So let's take a look at D.R. Horton, and I'm just going to illustrate a trade that wish this implied move was bigger. If the implied move is much larger than average, in D.R. Horton, it is about average. So what I'm about to talk about isn't setting up fabulously well here right now. But that may change because they're not reporting until the 18th. So this is, keep your eye on this. So what might I like to do in a place like this? You know, this would be a situation where if the implied vol was high and the longer dated options were reasonably priced, and by reasonable I mean just sort of in line with where they historically have been, you know, I might try to take a look at calendar trade, strangle swap, something along those lines. What would that look like? So we know that the implied move is, you know, right now it's about 4.7. Let's call the average about 5% just to keep the math easy. And we know that they're reporting on the 18th. So we've got weeklies here. I can go to, as it happens, it's a regular way. So I can just say, all right, I want to sell a strangle on this thing. And I'm going to just move this down a little bit. So let's just choose, I'm going to go inside. So here's a quick point. Oh, this is kind of interesting, just worth thinking about. Standard deviation, some people talk about implied moves and standard devs interchangeably. They are not. Standard deviation is a statistical concept, basically talking about how much something moves around. And the mean absolute deviation is another statistical concept which also helps give us a sense of how things move around. One standard deviation means that for whatever period of time you're looking at, that just under 70% of the time you would expect whatever it is you're observing to fall within one standard deviation up and one standard deviation down, which is different than the mean absolute deviation. So the mean absolute deviation is the average of all possible deviations that a distribution suggests, and that number is typically going to be, well, not typically, it is lower. It's statistically lower than a standard deviation. It is, in fact, the standard deviation for a normal distribution, little mathy. You can jot it down. You can care about this or not care about it. It doesn't really matter. But the mean absolute deviation for a normal distribution with a standard deviation that you know is going to be the standard deviation times the square root of 2 over pi. But you don't need to remember that. Just remember 0.8. So whatever the standard deviation is, the mean deviation is going to be 0.8 times that number. All right? So if somebody tells you what the annualized standard deviation is, call it 20%, number that people throw around all the time. If you divide by 16, that gives you the standard deviation. Divide by 20, it gives you the mean absolute deviation. So when you're looking at what you think is going to happen, I like to look at the average move. And in this case, that's the mean absolute deviation. So going out to April 19th, that's going to be down to about 145 or 170. Another way to figure that out, I don't know why I make these things so complicated. It's because they're not complicated. Another way is just take a look at the straddle. see what the value of the straddle is. That's going to be the mean absolute deviation as well. So take that number, 145, 170. So what I'm going to do then is try to sell the implied move if I think it's really rich. And like I said, actually in DR Horton, I think it's fairly valued, but so this is for illustrative purposes. Go take a look at the straddle. Is it expensive? Is it not? The next earnings after this one is going to be in July, and we have an August expiration. So I'm going to try to capture that one in there, whatever. So we'll buy the 145 puts, and we will buy those, what did I have, the 170 calls. So that's going to look a little something like this. Right? So a couple of things to observe about this straight away. Number one, it has a bullish tilt. When you are in a calendar spread, you want it to, a straight calendar, you want the underlying to run to the strike. So your peak profits in this case would be if it runs that higher one. But because this has a bullish tilt, but it's not a bullish trade necessarily, if it runs to that downside put strike, you're probably okay as well. Now, this trade looks really attractive because it's green all over the place, and this is within the boundaries of the implied move. But I would caution you, because if the implied move is actually, about average, this trade is okay, but it's not great. You really need to have a judgment about whether the implied move is just too high. So that's another way to make these types of plays. Okay, so let's see what else we got here. Okay. Yeah, I do have CNBC today. The producer's reminding me, so I'm going to have to jump at some point for that. But I have a little bit more time, and I apologize. What's this? 4 UNH naked puts, just to clarify. Aaron Juarez. Okay, so the first part of your question, Aaron, must be on a different page. Where are we? Blah, 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 blah. Got caught with my pants down, sold UNH 485 puts, expires April 19th. How? Ah, yes. We were just talking about this. Yeah, that was a kind of a mess. A bigger mess for Humana than it was for United Health. Let me make a couple observations about United Health. First of all, I think it's a phenomenal company. One of the great growth stories of the last couple decades, without a doubt. I actually sort of became really first familiar with United Health back when I worked at CRT Capital Group. And our head of research then, Cheryl Skolnick, was just a huge fan of the company, very bullish on the stock. She used to beat the street up and down about it. And ultimately, the company hired her. She's actually an executive at United Health now. And they did well to get her, and I can see why they might like to have her. United Health has a couple things going on. So this Medicare stuff, that was part of it. But they had other problems even before all that, because the company was contending with these antitrust allegations. And actually, I have to say that it is because of this, it's because of these two dynamics that I actually am in favor of selling puts in United Health. Obviously, it didn't work out that well because the stock just gapped down. And actually, for those who don't know or haven't been paying attention to the space, managed care space, Humana's and so on, you can see that these things just got absolutely tagged yesterday. Bounced back a little bit today, which, by the way, I think is a very positive sign. So what I get most concerned about is when you see this type of a price gap, is there follow through? Now, it's a little early because we're only the second day into this, and usually I like to give it 3 days to sort of get a sense of where things stand. But I think this stock is actually about as cheap as it could be had at any point that I can remember since I followed the company in the first place. This was a company that typically was trading in the 20s in terms of its multiple to trailing. And, now where are we? We're sub 20. It seems very reasonably valued. I don't have an instant repair strategy, once you take a loss. And normally what I would say is your first loss is your best loss, especially if you're going into a catalyst. But actually, in this particular case, I happen to like the company. And I would like to wait, the 3 days, sort of look to see whether Real Money is starting to sell it. Real Money, for those who haven't watched prior episodes, I'm just talking about the big institutional holders, mutual fund companies, folks that do not move stock around that easily. We can see that they have some huge institutional holders. We've got State Street in here. We've got T. Rowe, Fido, Wellington. All of the big players are in it. BlackRock and Vanguard, I leave them a little bit on the side because it's not, that's mostly index money. So you don't have some guy sitting up there saying, hey, wait a minute, do we have to completely revisit our theory on this thing? United Health is going to, in the Vanguard S&P 500 fund, is going to represent, give or take, whatever its weight is in the S&P 500. That's not going to change. But active managers actually make those kinds of qualitative judgments in real time with access to new information, and they can pivot. And if they do pivot, the impact can be significant because they have so much stock to move around. And if you look at T. Rowe, they were sellers actually according to their most recent 13F, but they've got 30 million shares, and that's 30 million shares of a $460 stock. If they start selling this thing, that's meaningful. How do we know if they're selling it? Other than actually going in and seeing whether there's big indicated sellers. So who would you call today? I guess you'd call up Cowen and Citi. They seem to be trading bigger blocks of it today, and say, what do you got? Who is trading high touch? Citi. So the sales traders at Citi, they've probably got some kind of an indication of what's going on. But I would wait 3 days. I like the company and I like selling puts in it. So unfortunately, I can't help you on the 485s, but it's not a bad name to be short puts in, I don't think. Delta reports on April 10th, implied volatility 31-ish, historical volatility 23. Is there a trade? This is coming from PC. So Delta, the most loved airline on the street. I think, if I remember correctly, JP Morgan just reiterated an overweight in this thing today, if I remember. Am I correct? How's my fading memory? Yeah, they did. Oh, sorry. Morgan reiterated an overweight attractive yesterday on the 2nd. And I think, yeah, it is the most loved airline on the street, for sure. How big's the implied move here? 4.5. Hasn't done well the last couple of earnings, though, has it? And we've been on quite a run. Yeah, so, yeah, I think we have a position in this thing. Oh, my screen's up on this one. I think we're long, small in Delta. Let's take a look at the implied vol one more time. I know you said it was 33. I'm not doubting you. Not for earnings it isn't, though. Let's see what we got here. So my implied volatility numbers look a little higher than yours. 36.5. Could be model differences. So again, just for people who don't know, sometimes you have slightly different models. They have to be calibrated one to another. Yes, 30s, low 30s definitely sounded a little cheap to me. So actually, as long as it's in the 40s, then I definitely think you want to be using some form of a spread. This one actually might set up okay for one of those strangle swaps, excuse me. Let me take a look what the term structure looks like. So what other things you're looking for in this case, right? You're going to go buying calendars. There's a couple things you care about. One of them is how expensive are the longer dated options to their own history. It's great to sell overpriced short dated premium if it is indeed overpriced. And the options expiration that's going to capture it, that are the April 12th options, it appears. So those are about 45 vol. How does this compare? That's a pretty steep looking term structure to me. And you can actually take a look and say, okay, well, what does that longer dated volatility typically look like? And it seems like it has been cheaper, as low as 28 right about this time. Let's actually take a look at where were those options right after they reported last year around this time. Yeah, so look, I mean, I don't think there's that much downside to the much longer dated stuff. So I'm talking about two earnings cycles out. So this could be actually a good one for calendars. Okay. Oops. What do we have here? What did I just put in here? Silver broke out this week. Actually, kind of what we were talking about. As did the miners, like Pan American Silver. I think we had a chart on this one. Did we show that? I was just taking a look at that. Big move today. Pan American Silver. Is silver simply catching up with gold, or is there an industrial element? So that's a good point. Gold, I mean, there are industrial uses for gold too. It's used for heat shielding. It's used, for its conductive properties and so on. But silver obviously has larger industrial uses. I like both. And I like the miners, just as in the general sense, right? Bearing in mind that I want to see the breakout above that downtrend. Right, so that's what we're looking for, and that's the reason we're trying to use options to sort of trade through it. Okay, here we have, hello Mike, when selling strangles at 20 deltas, how often should I be adjusting it if there is increase in deltas? Also, what would be the ideal percentage to collect on strangles? Interesting point. Okay, so I have previously said that I don't like option selling strategies where you are not yielding at least 12% per annum if you annualize it. So that works out to about 1% a month. Why is that? How did I come up with that number? Anyways, that just out of the clear blue sky? It is contextual, so it's going to vary from stock to stock. But in the general sense, why is that? It's because when you sell insurance on an equity, you are taking an equity form of risk, whether you're selling upside or downside. So you're selling a downside put, you're essentially taking a long equity risk, and if you're selling an upside call, you're taking a short equity risk. It could blow through and you end up short the stock. Well, if I'm going to take equity-like risk, I want equity-like returns, and equities return about 12% a year. That's a more recent history. The longer-term history is a smaller number. It's like 7.5 if you go back 100 years. But, we're talking like since 1990, the average return for equities is going to be in the neighborhood of 12% total return, something like that. Why take equity-like risk if you don't get equity-like returns? So that is sort of my starting point. More volatile stocks, higher beta stocks, the number has to be higher, and lower beta, lower risk stocks, the number could conceivably be lower. But we don't generally, we're not getting into this whole thing just so we can sell calls on Kroger or Campbell Soup or something like that. I mean, that's, it's fine if that's what you're into, but for most people, that's not what you're going to be trading options for. So when you sell strangles, the same logic applies. So here's the interesting question. Does that mean I need to get 1% per month for my calls and 1% per month for my puts because I'm taking risk to both directions? Well, I suppose one could make the case that that's true, but you can actually push the strikes further out and reduce that premium and still take an equity-like risk. And the fact is that at expiration, the stock can only be below, between, or above these strikes. The stock can't be in two places at once. So you can't lose on the call and the put at expiration. unless you're getting whipsawed. And how do you get whipsawed? By adjusting it. So that's the other part of this question. So do I mind collecting 1.5% on this, as little as 1.5% per month on short strangles? Well, if I was busy selling 1 month strangles, I guess that would be acceptable, particularly if I could find ways to hedge it. It's not going to cost me 1.5% per month to buy strangles on the SPX right now, so I can get into a trade where I'm short premium on a bunch of single stocks and long it on an index as a hedge on both sides if I choose. We actually have a position like that on, so that's not totally unreasonable. But do be careful about over-hedging around these positions, because you can really beat yourself up that way. And one of the things I like to think about when I am deciding whether or not to adjust hedges on the short side is actually my trading ranges and valuations for the stock itself. So, for example, if we have situations, and there's a lot of cases like this, where the stock is, it's going back and looks like it might be retesting an all-time high. When you initiated the short side, you were well away from that short call strike, and now it seems to be migrating to it. You sold that upside call strike because it was beyond the all-time high. You're still below it. I might not adjust, even though my deltas on that call have gone from, call it 20 to 30, or maybe even 35, I'm not necessarily going to adjust that thing straight away. I'm actually going to be keeping a close eye on that level. Do I actually still believe that the underlying is going to hold at the previous all-time high, or at the very least pause there, which is exactly what you want if you're short that upside call? You might have a little bit of intermediate pain. So the caution you have to worry about is it going to blow through that? That's going to be a judgment that you make on your own, but I would caution you against over-hedging these things. I did point out, when an option longer short gets to 60 delta, I'm almost always going to be adjusting it then. All right, what do we got here? I got a lot of things. We are an hour in. Oh. I have chewed up a heck of a lot of the time of those of you who managed to stick around for all of this, which, as always, I really appreciate. If you have not already done so, please like, subscribe, comment, offer suggestions. As I pointed out, we got to a question today that we had not previously gotten to. I will try to in future videos. And the next one is going to be coming up next Monday afternoon, 4:15, right here. I will see you then.